Good evening, TheoTrade. This is Corey Rosenblum, and you're watching the Theo Nightly Video for the 28th of January here in 2021. And we have major tech stock earnings behind us, namely Apple, Facebook, Microsoft, the others. We'll include Tesla in that list, even though it's not quite a technology stock. It does count as a monster of tech, so that is important to note. And what we're seeing here is the S&P 500 is the futures contract, and we've had, I'll pinpoint this volume profile logic, which has taken the market from the upper value area extreme down beneath. This right here is roughly the weekly expected move. That was a support level yesterday on Wednesday session. But the market cracked under and fell into the close. And when the market's underneath these levels, the good probability states that there's a bounce likely. Guaranteed? Never. But certainly more likely than not. And the same logic if we're into the upper expected move or into the upper value area extreme, that's going to favor a pullback or a retracement or sell side activity. All that's happened, and the market has closed right now, S&P at least, on that value area extreme. So things are working out fine on the short term, but you're probably interested more on the big picture. And this is the Nasdaq. We'll just compare the S&P to the Nasdaq, which again fell from this upper value area extreme down to the target. And that target was roughly 13,000, which is achieved and reversed at the close yesterday. The red line is the point of control. It's just the mean. Think of it like a standard distribution table. Think of it almost sort of like this that we draw in the option market quite frequently. And we have 68% of the price data within one standard deviation of the mean. So this top yellow and the bottom yellow on the profile is simply the one standard deviation of price and volume data. And the red line, or just think of it as the midpoint on the chart. Again, all that is mean reversion logic. And the logic is, again, from this upper value extreme back to the midpoint, and from the outer extreme back to the midpoint. So that is a help to us on the intraday or very, very short-term world. That played out well today. Now let's go ahead and update our earnings. Taking a look at Apple, that was an interesting one because they had decent earnings. The earnings were actually quite strong. And in terms of the actual was 1.68, but the estimate was 1.4. And we see the beat, but the stock in the after hours was good, but not quite perfect. And we have the stock down after earnings. And that played bearishly, right? That's expected. Markets overbought, overextended, above the averages, above the value extreme and all the targets. The logical plays to the downside. So that again is playing into the logic. Tesla is a little similar, even though it's been stronger. Very strong, actually. So I had this level drawn, and we're back to that moving average. So I know we don't trade necessarily like this, but markets that get overextended, think of it like a rubber band. Think of that green line like a rubber band snapback. And the market can go a little bit above it and get pulled back to it. This is price. Go a little bit under it, be pulled back inside, go a little bit above, pull back. But if we start to pull that rubber band far, 5, 6, 7, 8 days in a row to the upside, that's going to favor bear positions or sell positions or put type of positions to get us from this overextended pull to snap right back to that average. That's the same logic we're talking about volume profiles and expected moves. Mean reversion. Reversion to the mean. And that mean is just the moving average. And again, the farther we pull up from the mean or get stretched from the mean, and the mean's going to move, of course, the quicker the market does come back. So that's the logic with which we had in Tesla and other stocks too. Of course, earnings are a event that they could go either way. So volatility is certainly playing into these option positions or trades that we might take. Facebook is more range bound. So in all the tech stocks, some of them are making new or close to new all-time highs. We can take a look at Google as one of them. 1900 per share. Again, the same logic, like a rubber band. If the rubber band gets stretched, the price or the rubber band snaps back. That allows us to put trades on as what we call fade or a mean reversion, as opposed to a trend type of trade, which buys. That's my preferred type of method, but it buys when the price is at or near a rising moving average. But we're talking pullbacks and snapbacks right now as we speak here at the end of January. So Google is a strong stock getting stronger, unlike Facebook, which has remained range bound at the 290 and about 250 per share level. You'll see a similar pattern and that little diamond or the big expanded triangle, whatever technical term you want to use there. It's just a range expansion back to contraction. And the price for Amazon shares remains in a sideways trading range. And that is about 3,400 to 3,100. Wide range, yes, but that does allow some short-term tactics. Shorting into this high and trying to buy into the low, or playing back to the middle. So all these stocks are in play. All these stocks are playing normally. A market still is overbought. Same logic takes place. It's a steep pullback. We always have this concept that the market can creep, frustratingly so, higher, and then within 1 or 2 sessions snap back. Creep frustratingly higher, and then snap back. And that does favor short-term sell type of opportunities when we are stretched, and then long or buy opportunities when we're back to the mean or the average. That's the play from the perspective there. We are getting our bullish January creep, but as we come into February, that's when the model starts to be a little more cautious. And if you are looking for that deeper pullback, every day brings us closer to it. And that logic just is not a prediction, but taking us back. We'll look at the SPX to get a sense of what we are seeing unfold, what we've been talking about at the end of 2020, just expecting January to be bullishly drifting higher. So far that's happened. But every day that the drift continues brings us closer to the next thing that we are prepared for, eagerly awaiting, or whatever the case may be, which is this. There's the stellar drift in 2018. Zap. Big rubber band. And we replicated the same logic 2019 into 2020. Snap back. Now, of course, that was the coronavirus crash, but nevertheless, January's drifted higher, and February brought a steep sell-off. So if you aren't already, it's well past time to get those put positions or risk hedge or different types of trades that take advantage of volatility expansion. Never guaranteed, certainly not. Every day, every month, every week is different, but patterns repeat, and they give guidance, not predictions. So guard your risk, know the opportunities. Key stocks are still in play. We still have earnings, and in fact, on tomorrow's session, we're going to have earnings coming up from, to note a few, Honeywell, Caterpillar. We'll just take a look at the charts. Caterpillar is a strong stock getting stronger. We'll start with a pullback with earnings. Honeywell, similar. And then we'll have Chevron, Texaco, some of the oil or energy stocks. And down the list, a few others include ConocoPhillips, Pfizer, UPS, ExxonMobil, and then Amazon and Google, Abbey Labs, and PayPal. They'll report next week. So we'll play the earnings game once again into the first week of February. Be safe, be careful. This is Corey Wisbloom with tonight's Theo video update for January 28th, 2021.